Major averages trading slightly lower today as the Fed gives no indication there's going to be rate cuts anytime soon. The minutes from the last FOMC meeting revealing monetary policy will need to remain restrictive until data shows inflation cooling more towards the Fed's 2% target. Joining us now in studio is Krishna Mermani, Lafayette College Chief Investment Officer. Thanks for being here, Krishna.
Yeah, thanks for having me.
Good to see you in person. Thanks for coming in. So the minutes today just seem to confirm, maybe solidify the market's view that we are not getting any more increases, even though inflation still remains elevated. So how should investors be thinking about this?
So I think the right way to think about it is inflationary pressures have certainly peaked, and therefore tightening pressures have peaked as well. The question is, how fast do we get to 2%, and what would be the pace, and how does the Fed kind of operate in that framework? I think for the near term, the downward trajectory probably is going to be slow, but I think things are building up where the pressures could actually, of inflation going down, actually increase quite substantially. If you look at used car prices, for example, and you look at retail sales, things are slowing down, and in that environment, inflation can go down much faster than what the Fed is anticipating today. May not be today, but in the first quarter of next year, second quarter of next year, things could change dramatically.
And Krishna, you know, we had this nice rally in the equity market as investors have become much more comfortable with this idea that the Fed is going to really stick the soft landing. It's a rare, tricky thing, but I think investors are comfortable with that scenario. Is that what you forecast in 2024, a soft landing?
Absolutely. I think everything right now is looking like it is about a soft landing rather than a hard landing or inflation reaccelerating. I think when people talk about it being rare, I think they're talking about a regular economic cycle. This isn't a regular economic cycle. We wouldn't have gotten to where we got to, and we couldn't have come down as fast as we did from an inflation standpoint if it was a regular cycle. And I think all those pressures are fading, and I think as the Fed tightening impacts the real economy, things are going to slow down. The question is, how fast do they slow down? And I think for the soft landing, what you're looking for is really things trending to slow down rather than reaccelerating. If things don't reaccelerate, we have a soft landing for sure.
And so all of that being said, what happens to stocks then in 2024?
So I think that's actually a good question, because what happens to stocks in 2023 is dramatically different than what may happen to stocks in 2024. Because right now, we are probably at the top end of the trading range until things kind of improve meaningfully. But for 2024, especially in the second half of 2024, you have lots of ingredients for things to fall in place in a really good way. And I would say, you know, inflation slowing down, growth continuing. I mean, growth not like the third quarter of last year, but with a two handle, that's very reasonable. Earnings continuing to go up, and most importantly, real rates coming down because the Fed thinks that it has kind of landed the soft landing, if you will.
And so, Krishna, you sound constructive on the equity market as we head into 2024. Given that backdrop, what are the sectors that you think are attractive right now?
I think that's the environment where, when rates are coming down, that's not the environment for value stocks. That's an environment for growth stocks. So clearly, tech or certain parts of tech have had a very good run. So maybe they don't go up as much and catch up to those valuations. But there are lots of other growthy parts of the market that can do very, very well. Small cap, I think the valuations there are extraordinarily attractive. I think they cannot remain in the dump that they have been for as long as they have been in that sort of an environment.
Well, I'm sure I've asked you this before, but it's been a while since we've talked. So you managing an endowment, and you've been a veteran in the financial industry and have managed institutional funds as well. Managing an endowment, how is that a little bit different in terms of what your mandate is? And can you go out the risk spectrum a little bit when you see opportunities like that?
That's an interesting question, because I think if you think about it, in the institutional space, endowments are the biggest risk takers there are.
Oh, really?
Oh, absolutely, by a wide margin. You look at their, not Lafayette, not to the same level, but because they have higher hurdles that they want to meet with respect to returns, and therefore private markets, venture capital investing, things like that are very, very large parts of their portfolio. So they take substantial amount of risk. You know, the way you manage an endowment is from a long-term perspective. So tactical allocations in that environment perhaps is not what you're looking to do. Having said that, the growth orientation of most endowments is quite substantial. So this environment would actually work very well for endowments.
Huh, very interesting. Krishna, thanks. Good to see you. Krishna Mermani talking to us about markets and endowments for that matter.